regarding covered call strategy. A gentleman happens to be online here today, and the question was, what should my expectations be for gain or loss on a covered call strategy? And further going on that a little bit more is looking at your search results in the covered call screen. What can I expect as far as the number of stocks that move down and go against me? Well, that's a tricky question to answer, but of course I do have a way to answer that. So let's just take a look first at the covered call strategy. Very common strategy, most popular option strategy, not really because of the best risk-reward structure. It's the most popular option strategy because even new investors who apply to trade options are usually given level 1 trading, which allows them, of course, to trade covered calls. Then level 2, you can buy calls and buy puts, and then 3 and 4 and so forth. But even an investor, several subscribers I talk to, for example, on a weekly basis, may have 15 to 20 different bear call spreads, bull put spreads, iron condors, debit spreads, for example. But somewhere in their power options portfolios, they're tracking 5 or 6 stocks that they've had for years that they're just selling calls against. Now, they don't consider themselves a covered call trader, but technically they are still trading covered calls. But that's not the bulk of their portfolio and the bulk of their options trading. So in any case, when we talk about the standard covered call, of course we buy stock, we sell a call against it, but there's 3 real ways to approach the covered call structure. If you're opening a stock from scratch, we of course can sell an in-the-money covered call. Let's say our stock price is right here at 50. So I might buy the stock at $50 per share and sell to open, let's say, a 47.5 or 48 call for maybe $3. Well, it's an in-the-money covered call. We're below the current stock price. We're giving up intrinsic value to have a higher probability of getting the max return because the stock can stay the same at 50. It can fall to 49 or 48. We'll still get assigned at 47.50. So we have a higher probability of making the max return, but we have a lower return value with an in-the-money covered call and a higher probability of making the max return. Now, in general, in a normal, stagnant market going in the money, yeah, we're going to have surprises. Stocks are going to swing, stocks are going to rise, stocks are going to fall. In a normal trending market, we'd probably expect 8 out of 10 or maybe 9 out of 10, probably around 8 out of 10 covered call positions that are in the money by more than 2% would likely get assigned. And then the other 2 might move down below the strike price. You might not be at a loss, but you might not get assigned. The at-the-money covered call, if I sold right at the 50 strike price, is going to give me a good average percent return if assigned. And I've got only about a 50-50 shot, in theory, of getting assigned. Well, that's fair game, right? Buy the stock at 50, sell a 50 call, collect $1.50. It can move up above 50 or it can fall down. So you're going to use stock criteria, and I'm going to talk about that in a moment. But here with an at-the-money covered call, you might be hoping for around a 60% success rate, meaning 60% of the time, 6 out of 10, the stock stays above your short call strike price and you get assigned, and 4 out of 10 times it might fall. Now that might mean 3 out of those 4 out of 10 times, 3 of the 4, might just drop a little bit to where you're at break even or maybe even a small profit. 1 or 2 might drop down to where you've gone below the break even and are at a loss. Now, the third one, of course, we're talking about the out-of-the-money covered call. I buy a stock at 50. We sell a 52.5 call that's above the current stock price. In this case, we might expect sort of the reverse. Even with good quality bullish stock criteria, but unless we're in a good bullish market like we saw for most of 2017, remember 2018, 6 of the 12 months were actually negative market performance. But in general, with an out-of-the-money covered call, you might expect 3 or 4 out of 10 will get assigned, and maybe 7 to 6 out of 10 would expire worthless, meaning the stock would stay below 52.5. That doesn't mean the stock necessarily fell and you took a loss, although it might. More likely, it means the stock never reached 52.5, so your call expires worthless. You can choose to sell it again. Now, what we try to do at PowerOptions, and what we have done for you, is we've put together default criteria in every strategy, including the covered call. Everyone has a different way of trading. People, investors I should say, who are more speculative might want to go out of the money with their covered calls, hoping for the appreciation, feeling we're in a strong bullish market, looking maybe for a 5 or 6% return if assigned, but only a 3% downside protection. So you might start with the out of the money default search. If you're more conservative, you're probably starting with the in the money covered call search. You're looking for a good return of maybe 1 to 2% every 20 to 30 days, but by selling in the money you get a higher downside protection. So the stock can fall 5, 6%, you still might be at break even or at a small profit. But you're not going to get as high a return as you would with the out of the money, which the out of the money offers you no downside protection, very low probability of getting assigned. Whereas the in the money, you have the high probability of assigned, lower return, better downside protection. Okay, so take a look at NRG here. We could go deep in the money at the 35 strike for April, 20 days away. It's only a 1.1% return if assigned, but you've got almost a 19% downside protection in that case. Now, as far as the search goes, all the defaults we started with are looking specifically for what matches that title. But in addition to that, what we'd look for with an in-the-money covered call, higher downside protection. We have to account for a lower percent return. Going to go one strike in the money. Might want a good delta of maybe 0.6 or greater. We could put that in, or a higher probability of being assigned as well. But regardless if we're doing in, at, or out of the money with a covered call, it's a neutral to bullish position. So we're looking for stocks that have a good positive earnings per share growth in all three searches. Avoiding earnings between now and expiration, because I don't want that surprise that you can't see in a stock chart or with any other fundamental or technical analysis. And at the same time, we want to look for stocks that are in an uptrend as well, because the stock is important. So that's what we've set up for you, our default settings, whether you're an in the money, at the money, or out of the money covered calls trader. And we've even gone beyond that. And what Ernie did is he did specific tests over periods of time using monthly covered calls and even weekly covered calls. And he put together criteria that he tested to see which criteria would give the best results over time. And that's the monthly picks of the day and the weekly picks of the day. You can access those in the search, but we also have a quick view for you as well for the monthly picks of the day. And then over here on the far right-hand side, you can click that link to see how we developed these results to review Ernie's testing process, things that he found why even in a bullish trend, 3 to 4 months, the out-of-the-money covered calls didn't perform as good, as well, I should say, as these in-the-money covered calls, especially when he looked at a portfolio long-term. And so that's what that's what's designed for you. That's what the searches are about. And again, in that beginning, we had mentioned what my feelings are that your expectations would be. If I'm in the money, following the in the money search, I'm expecting in a normal market condition of bullish, 8 to 9 out of 10 will be assigned. 1 might move against you for an unexpected event. Some months you might be right 10 out of 10 times, and then the next month you might be right 7 out of 10 times. Not that you're right, but the unexpected happens. That's the risk of the covered call strategy, which in my opinion can be solved by trading long collar positions or married put positions, which give you that limited risk guaranteed downside better than a stop loss, and still leave the upside open in the case of the married put position. An at the money covered call might be a 50-50, but in a good bull market, you might expect 60 to 65, maybe even 70%, 7 out of 10 will get assigned and earn you that good return. And then going out of the money, maybe 4 out of 10 will be assigned. That's not to say the other 6 are losers. You still might have 1 or 2 that might just fall out of bed. But again, the problem with the basic structure of the covered call is if I'm making 1 or 2% when I'm right, maybe 3% with an at-the-money covered call, one stock that falls 8, 9, or 10% might wipe out 5 or 6 previous successful trades depending on my structure and on my stock selection. And that's where positions such as the long collar can come in to help you hedge against that loss to the downside while still seeing a reasonable return on a 20 to 30-day trade as well. Okay, so, well, Sam makes a comment here. He says, hi, good afternoon to everyone in the room. And he says, what if you have a straddle with covered calls about 3 to 6 months expiry? Then what? You sell 2 calls and let the put run if the stocks drop. So I think what Sam's referring to is having a covered call position in place, but then adding a long call and a long put, a straddle or strangle in there to take extra access one direction or the other. And of course, the answer to that question, unfortunately, is it depends what the stock does. We'll look at a structure. I'm just going to take off the cuff here. I'll use Starbucks. It has a reasonable volatility. It's one of the trades I'm in as a married put position. But let's say today we just bought Starbucks at about $74 per share. It's kind of where it opened at today. Let's just buy 100 shares. And we do a covered call. Let's go out to April, and let's just use the at the money. We'll use the 74 strike. Slightly in the money, it's at the money. Will give us a good maybe 3.5% return for 20 days or so. Oh, sorry, it's only 1.4. I was thinking of the downside protection. My apologies. All right, so I'd like a little bit higher here on that, but that's okay. So for 20 days, 1.4%, not great. We might look for a little bit better with the search. But we see our structure here, of course. The stock stays above 74. We get assigned, earn the maximum return. Lower the break even down to 72.96. Not too bad, about $1.37, of course, below our purchase price, 74.33. Oh, that's why. This return would look better if I did it just at 74 where the stock opened today rather than at the close price. That's what I was saying about 1.9, almost 2%. That's okay. Now Sam's comment is, what does it look like if you add a straddle or a strangle? Just where you buy a call and you buy a put. If I did an at-the-money straddle, buying the 74, let's say maybe even same expiration, or he mentioned 3 or 4 months out in time. But let's just say to June, oh, I have a 75s, not the 74s. So let's just buy a 75 call, buy a 75 put. Essentially what this is going to look like is a collar position where I've sold a call and bought a put. But at the same time, I have a 75 call which will leave the upside open and not cap the gain. Okay, so this is a different covered call structure. We do have a capped risk on the position of only 4.3%, but the one thing we did is we moved the break even up due to the costs of that straddle position. Break even still not bad at April expiration, shorter term April call, and using the straddle or strangle inside of it. But then again, remember the total cost basis in the position is 78.35. This, of course, is using an at-the-money put, where typically with a collar position, I might be buying a put with the same expiration of the call that I sold at the lower strike price for a cheaper price. So I might be selling the April 74 and buying the April 72. And if I bought an out-of-the-money call, this risk would increase, but it would still leave the upside open in the case that the stock would run. What Sam's talking about here is sort of a solution to the issues with the covered call strategy, where some investors say, hey, I like the covered call idea, I like the idea of generating premium. If the stock goes up, I can roll it, but I don't want to pay that much to roll the call, meaning that if I sold this 74 call here on Starbucks, and the stock suddenly goes up to 77, then moves up to 79, it's going to cost me $5 or $6 to buy to close that call. And I can roll up to the 80 strike, 79 strike, but I'm not going to get $6. It's going to be $2, so I'm paying a debit to hopefully get assigned maybe 5 points higher. Now you have to decide if that works out. All right, so let me just clear that out there. But what Sam's suggesting here, an idea that Sam's suggesting, is one of the ways that you can enter a covered call position but leave the upside open. Another way I could do this, instead of having the capped gain, is keep in the same month and add, say, a 76 strike call So essentially what this looks like is a synthetic long position where I have the obligation here between 74 and 76 to deliver my shares of stock, but if it shoots up, I still have unlimited upside. But as Sam mentions now, we haven't addressed the downside. Just like a covered call, we still have 100% risk if it falls. Okay? Yeah, so it's like a collar, but you could sell 2 calls this way. Okay. All right. Yeah, so we want to focus on risk control in that case as well. All right, now, let's see, scroll back here. Sorry for the clicking noise. But I want to go back to just the covered call here. We're going to address Glen's question. So let's say that here I'm in this covered call on Starbucks. It's currently at 74.33. I've got the 74 strike. Glen's example is a little bit different. So what Glen's asking is, if the stock is in the money on the covered call is 15, and the stock is at 18, and you get assigned, do you get assigned at 15 and then sell the stock at 18 for more of the profit? No. And he mentioned X in there, so I'm not sure if he means at X dividend date or just means assigned early. Let's take a different example. Let's lower this down to 73.75. And I'm going to go ahead and just go to April, Glen, and we're going to put in the 72.50 call here. So this is going to be our in-the-money covered call. But I'm going to put in a value of, yeah, it's probably about right. Let me just take the natural price here at 243. That's going to be a good return. 1.7% for this deep in the money covered call. Now, Glen's question is, if I get assigned, of course, do you get assigned at 15 and then sell the stock at 18 for more profit? No, that's not what happens. You own 100 shares or X amount of shares of your underlying security. You sold a call against that stock, with how many shares that you have, okay? So if it's a 1-to-1, Glen, I bought 100 shares, sold 1 call. Bought 300 shares, sold 1 call, or 3 calls, sorry. Where it's even, number of shares to number of contracts. What I've done here is I've entered in an obligation to deliver my shares of stock to someone at 72.50 if the stock is above that price. Getting assigned means my shares of stock, my shares of Starbucks here, are sold to the long option buyer, whoever exercised that long call, at 72.50. In this case, if I was assigned early, I get 72.50 for my 100 shares of Starbucks, but I lowered the cost to 71.32 because of the premium we took in. So my max profit is 118. When you get assigned, you're fulfilling your obligation to deliver your shares of stock at the call strike price, and you were paid for that obligation. You decided to give up your shares, and you were paid handsomely, hopefully, to give up your obligation. So if I'm assigned early, the stock is gone, the call obligation is covered, I am no longer in the Starbucks position. I have sold to close my stock effectively, is what it looks like, but really I'm assigned. But my broker sells to close my shares at 72.50. I'm out of the Starbucks position entirely. I don't have the shares again to deliver at 18. Such is the case in the X dividend date. Why would I be assigned early on a position? Think about it this way. It's never a 1-to-1 ratio, meaning that when I sold this call, 1 strike of this call, let's say I sold it today, I'm not linked to Joe the option buyer. That's a J-O-B, Joe the option buyer, job, who purchased this at 245. Now, there might be someone out there who bought 1 contract at 245 around the same time. Remember, options are in a pool. I sold 1 contract at the 72.50 strike today. Another investor might have sold 4 contracts, and another investor might have sold 5, whether it's part of a spread, whether it's a covered call. So now what do I have? I have 10 contracts wanting to be sold at 243. So 3 different investors. One investor might come in and buy 10 contracts. He wants to buy 10 contracts at 72.50, and he might pay 245. So it's not necessarily that I'm linked to Joe the option buyer. This could be done multiple ways. I could have sold 10 and there'd be 3 option buyers on the other side. But what's key is this is all in the pool. So all options at the 72.50 contract, let's say the open interest is around 500, well, there might be 250 sellers and 250 buyers over that time. 250 sellers, 250 buyers, but remember, not everyone is linked. It's done in a first in, first out basis. What do I mean by that? Meaning that down the road, this investor here who sold 5 contracts, someone a month ago who bought 5 calls of Starbucks might say, you know what, I want to exercise my 5 calls, or they sell to close them because they've made their profit. Well, the market maker is going to look and try to find the first batch of 5 open contracts. In theory, he might look for 5 directly, or might look for a group of 2 and a group of 3 of the earliest investors who sold the call. But let's say 60% of investors who sold their 72.5 calls at the beginning have bought to close their calls already, or rolled them, for example. So the person 3 days ago who sold 5 contracts might get assigned today because it's the first lot he found that was an even 5 contracts to that match. It can work different ways like that too, but in theory that's what's happening. So he's not linked to the person who just bought 10 contracts today or yesterday. We're just all in a pool together. Why is that important, that little rambling I just gave you? As Glenn mentioned, coming up to the ex-dividend date, investors who own these calls, even if the stock is, say, at 72.70 or 72.60, maybe even if it's at 72.40, if the dividend coming up, let's go high. It wouldn't be this high, but let's say the dividend is 25 cents. Well, this strike is 10 cents away. So if the option buyer exercises and takes my shares of stock at 72.50 and gets the 25-cent dividend, he's effectively got a cost basis of 72.25. He's on record of holding the stock on the dividend. Now he can choose to sell to close the stock as long as he holds it through that day and is on record, and then he'll collect the 25 cents later. So sometimes you see early assignment in that case. If very positive news comes out on Starbucks on Monday and it gaps up to, let's say, $82 or $83, someone might exercise me early at 72.50, even though we still have 20 days to go, or in this case, 18 days to go. More than likely what happened in that case, all the call buyers who bought the strike at 72.50, when they see the stock jump up to 85 or 86, they've reached their profit, they're going to sell to close those calls. Okay, so now what does the market maker have to do? Well, he's going long and short stock in between to cover the hedge for the sells and for the buys and vice versa. So if all of these option buyers start selling their 72.50 strike, he's going to start assigning those who sold at 72.50 so that he has a balance of buyers to sellers, whereas before here, all these selling to close, he doesn't have a balance now for the number of shares between the two. And that's sort of a basic way of looking at it, but the idea is when you're assigned, you give up your shares of stock and you don't have to worry. You don't have the stock remaining, I should say, Glenn, to sell to close it. You're out of the stock at 72.50. That's your obligation that you entered when you chose to sell the call. And if you're assigned early, you do not have the control over buying to close the call to cancel the obligation or rolling it as it goes in the money. If you want to avoid assignment because you're in a stock that's a long-term holding or you accept more appreciation, as it starts to go in the money, you want to buy to close your call and then maybe roll it up to the higher strike. You had mentioned a stock trading at 18 where we had maybe sold the 15 strike call and we're in the money. Well, if you want to avoid assignment because this is a long-term holding, you're going to want to buy to close this call and it's going to be expensive, and then you'd look to roll it up to maybe the 19 strike or the 20 strike, hoping for further appreciation. But this is going to cost you more than you're going to get here if you stay in the same month or maybe even go out 2 months. You're going to be probably rolling for a debit at that time, but the idea is you'd get a 4 or 5 point higher return if you were assigned at those higher strike prices if the stock continued to move up. All right, so that's the case there. Yeah, Sam says he's in Starbucks at 65 and he's still holding that position. I'm in its higher stock price, but it's in a married put position as well. Okay. Other comment here, the market is toppy day, lots of stocks gap up in the open. Yeah, I saw that. And sideline for more downside risk is upon us. Yeah, we've talked about it before, Sam. You've seen it in some of the positions that I've been in. TREX was a strange ride this week, and I didn't adjust my married put as much as I probably should have, but I also didn't want to overtrade it. Let's just go here. Let me go back home. Yeah, TREX right now, it's down $1.70 today. It is all over the place, and I'm still thinking this is going to go negative on me some more. You can see by the chart. Let's just look at a 10-day chart here. I think it'll allow me to do daily. Let's try it. Let's go hourly. My apologies. Yeah, so we had a big dip down here on Wednesday. It dropped down below 60 for the first time in a while, and then suddenly just shot back up Thursday, 6% gain back to 64, and then today it was down another $1.50. There are different ways to play this over the last 3 days. It was wild, though. So I'm still in a married put with a low-risk position, but it has been trending downwards, and I thought it had... I wanted a confirmation, is what I was looking for yesterday. I wanted a confirmation that would break above the upper band and maybe close above it. Did see that positive MACD crossover, but it doesn't look like it just wants to break. It looks like it's hitting that 64 level and coming back down here. It's really about 63. Once it broke below 64, it doesn't look like it's going to do that. So I'm going to have to reevaluate this position and see which way I go as well. Yeah, you sold it with a small loss. I understand. I probably should have exited this position personally, or I know what I should have done in the married put position, but I didn't do it. So I should have exited this a little while ago. It's down. I'll be honest with you guys. It's down 18 to 19% from where I bought it. The most I can lose on the position right now is 4.5% in that married put structure. I could be sitting on a 10% return had I done something different following the radioactive trading techniques. I was just hesitating too much, and I didn't do the certain income method I should have done when I saw my signal, and it turned out that, yes, I should have done that, and I'd be sitting on a double-digit return right now. But that's okay. I'm comfortable with the 4% loss. Would love a win, comfortable with the 4% loss as well. Okay, so we talked about that, the covered calls, of course. Oh, there it is. There's the question I was looking for. Is it Juan? Yes, I'm sorry, Juan. Juan says, how do you know where to roll the strike price to? Okay, so this is in the covered call discussion. Juan didn't really mention that, covered call, but I think he was talking about when I'm deciding between the 19 and the 20 in our $18 stock example. Let me find, pen's okay, but it's not that great. It's close. We'll use pen. I'm going to take a quick historical look at pen. This is something I traded last year. Oh, no, it's severely down, not up. Okay, so, well, no, it's about the same. We're going to say a couple months ago, that's not a fair assessment, but I'm just going to use it. Okay, let's say that we had a cost basis on pen of around $18. We bought it back in December, rolled some calls, sold some calls, and we saw pen is now around $20. But let's say we've got a cost basis of 18, and we're currently sitting on maybe the April 17.5 strike, even though it's been pulling back. So let's just add that covered call in. So regardless of the time, I could put December in. Let's just go to the 1st of March here, even though we couldn't get the stock at 18 at that point. But let's say we've been rolling this since December, mid-December. I've got a cost basis of $18, and I'm sitting on the April, let's go deep. Let's go 17 strike. But let's say that we only got, maybe $1.30 for it when we sold it. Okay, and now the stock is up to $20 per share. So this is still a really strong return, of course. Owning the stock at 18, selling the 17 call for $1.30. Not great, but it's still a reasonably strong return. It'd be 1.8%. Well, depending, if it was a 10-day trade or a 15-day trade. So maybe not as strong as I'd hope, but still. Here's our covered call. And let's say the stock has moved up to 20. Now, the Power Options tools, once you enter it in the portfolio, as I just showed you, in addition to tracking the position and being able to see very quickly what your original expectation of your profit was on the position. You don't see one here because these are long calls and long puts that we looked at last week that, well, the long call has an infinite expected profit potential and the long put has an infinite potential profit to 0. But here's what I was originally expecting. Right now, here's my liquidation loss. If I sold to close the stock, bought to close the call, I'd be at a loss of 3.6%. And if I hold it to April and the stock stays where it is, we'll get assigned and make the full 1.8%. So I can see that all in the portfolio as a gauge of where do I stand right now and what might I want to do. Well, I don't want to liquidate because I'm looking at a loss. I could wait another 20 days and take 1.8%. But the idea is I think Penn's going to continue to go up. This is an important factor. It's trading at 2010. I think the stock's going to continue to go up. I want to look for a little bit more upside return. What is it going to cost me to roll and what roll makes sense? Anytime you're tracking one of the standard positions in power options, the 23 I mentioned that we support covered calls, credit spreads, married puts, collars, even just buying a call or buying a put. You can link from your position that you entered to position actions here and then position analysis. This tool gives us a breakdown of our current position, where we stand right now. And of course, there we are, liquidation value of 3.6%. We still have 20 days to go to expiration. And at expiration in 20 days, we could make 1.8% as long as the stock remains above 17, our obligation of our short call strike. And down below, we see some rollout opportunities. Now, we see positions where I could roll to the May 20 call to go for a 2% return, and it would cost me a debit of 160. Okay? So this table, what it's showing you is which rolls are possibly available. What would your new debit or credit be? The negative value here, adjusted net credit, is the debit. None of these can be rolled for a credit, even going out to July, which is 112 days away. However, if I roll to July, 112 days away, I could double my return up to 4.7%, more than double. If I'm really bullish on the stock, we could roll up to the 21 strike, and that might be a 7.4% return if assigned in the next 112 days. Why is that important? Why am I highlighting the days to expiration? Juan, if this was my actual covered call position, let's say I opened it a week ago. It's got 20 days to expiration, so it's a 30-day trade. So I would have opened it because my target was to hopefully maybe get assigned and make 1.8% in a 30-day time period. Right? So that is my target, 1.8% in 30 days. Now my target's a little bit higher, but for sake of example. Now this is important because if I roll to May right now to the 20 strike, I'm rolling for a debit. It's going to cost me $4 to buy to close that 17 strike right now, and we're only going to get $1.10 back plus the $1.30. There's my debit of $1.60. Okay? But if I get assigned at 20, it's 2%. But that's for 49 days out. We're 20 days away now. So I'm adding an additional 29 days for a potential return of only 0.2%. This does not match my trading plan. It is completely out. If that return was at 3.6, I'd consider that roll from the 17 strike to the 20 strike, but it's not there. It doesn't match my trading plan. I'm not going to roll. As I mentioned, now the July shows that it's at 4.7, rolling up to the July 20, but this is 112 days beyond where I am right now. That's close to 4 cycles. Is 4.7 1.5 times 4? No, I'd need a 6% return, potentially. So the July 21 matches that, but what's the trade-off? Well, I'd be holding the position for remaining 112 days in the hope to get 7.4% if the stock is above 21. To be honest with you, Juan, in this case, I'm more tempted to leave the position as is for the next 20 days, get assigned. If it stays above 17, make my 1.8% return and move on. If I could liquidate right now for a profit, and it's probably not showing a good profit right now because I didn't put in the actual number. We sort of took the actual number it was trading at right now. But yeah, if I could liquidate for a profit of 1.5% now, and 20 days later would make 1.8%, in other words, I've made 80%, 85% of what I expected to make on the covered call and can liquidate 20 days early with most of that return, I'm probably liquidating today rather than rolling to positions that don't match my trading plan. Now let's say this July 21st one, 112 days out, did match your trading plan, even though you're still rolling for a debit, which is okay if the overall potential return still matches your goals for the position. Now here it's great to see this rollout opportunity manually, but if you wanted to get a little bit better look at it, as you've gone to the position analysis screen to see your rollouts again on any of the standard positions you're tracking in PowerOptions, see a rollout you like, click on Simulate Trade, and this will give you a side-by-side comparison. My original position on the left in red, currently at a loss of 3.6%, could make 1.8% if the stock's above 17 in 20 days, April expiration. Or if I roll the position, I could potentially make 7.4% at July if the stock is above $21. So you see the graphical interpretation there. I think I scrolled too soon when I opened it. That's better. There's better graphs. Sorry, it didn't really give you a good comparison. What is the risk of doing this roll? Well, as I mentioned, we did it for a debit. So by rolling to this July call and rolling for that debit, I've moved my total effective cost per share in this position and the break even from 1670 to 1955, almost a 3-point increase in cost basis. Now that's important because we can say this is worth it if it matches my goals. But I have to remember now my cost basis is higher, so if the stock pulls back and drops down to 17, here we'd still be at a profit. Here we're at a 255 loss. So when you do roll for a debit to try to get that increased return, it's important to remember that you're increasing the cost, and if the stock starts to move the other direction, you could have a significantly higher loss than leaving the position as is. Which, as I mentioned, if I saw this opportunity to roll up, let's say, 40 days out in time, 40 days from now, about another month and a half or 49 days to May expiration, and rolling to this strike gave me that 7.4% in a 49-day period, I'd probably be really interested in that roll. But rolling out to July, sitting on this position for another 112 days, with knowing I've increased the risk by about 3 points, which is a fairly significant percentage, isn't it, on a $16 stock. The fear of the stock pulls back and drops back to the original trading range of $18, $17, where I'd still have a profit here, I'm going to be at a significant loss. That's something you have to take into account with the rolls. Don't roll for the sake of rolling unless you feel really confident that further upside potential is there, And don't roll for the sake of rolling if the new potential return does not match your trading plan. And that applies to all strategies, not just covered calls. I'm in a standard collar. I'm in a diagonal calendar spread, and my short call goes slightly in the money. Well, if the volatility near term is too high and the buyback cost is too high, and by rolling that short option, call or put in that diagonal spread further out in time doesn't match my trading plan, meaning the new potential return against the days to expiration on that short option doesn't match my trading plan, don't roll for the sake of rolling. Might be better off just getting assigned, taking the return, and then looking for a new position. Or if you're at 75, 80, 85% profit of what you expected, if I could liquidate now for a 1.5 or 1.6 gain 20 days early, I might just liquidate the position and then look for a new stock to get into if none of the rolls match my trading plan for what I'm doing in the portfolio with that particular strategy. What I'm looking for covered calls, what I'm looking for collars, what I'm looking for diagonal spreads, and so forth. Okay, so Juan, that's how I know what call to roll to. I use the PowerOptions tools, and a comment might come in, well, what would the debit be if I rolled to the May 21 strike? That's not shown. Why is that not shown? Okay, fair question, great question. if I go to the position analysis screen on PowerOptions and I don't see a rollout or adjustment I was planning on doing personally, the first one that popped in my mind, hey, we're already at 2010, why don't I go out of the money if I'm still expecting the stock to go up? What would the May 21 strike look like? But it's not here in the boxes. I can't see it. In that case, I'll analyze it manually. And I'll scroll up here, and from the position analysis view, I can click on what if calculations. This is the same as being in the portfolio itself, and next to your position going to the profit and loss chart. It takes us to the custom spread tool, and it copies our information over. So now what do I have here? I have a covered call position on pen that's in my portfolio. I want to see what it would look like if I bought to close this April 17 call and rolled up to the May 21, which was not shown in the rollout opportunities. So I'm going to manually do that. I'm going to go to View Options, go to April. It shows me the 17 strike has already been added, but I'm going to click on it again because I have to simulate buying that option. So here I am, 100 shares, my sold call. Now I'm going to add in and I'm going to buy the call back. All right, so it's going to cost us $3.43, an increase in the debit of $2.10. So my new cost basis will be $2,012 roughly. Well, I'm sorry, it should be 2013 roughly, 2013. See, we lowered it down to that 1670, then we paid $3.43 back, so our cost basis would be 2013. Okay, so now I could just go ahead, add the May series in. We said the May 21, we're going to be at a midpoint of maybe 75 cents or so. That's a heavy debit, isn't it? We're still paying a debit of about $1.40 to roll up to the May 21 strike. Now it increases our return to about 8.3%. That would match my trading plan. But the problem is the debit is severely high now. Now we're still only at 1935 cost basis. We gained $1.35 total, but the 21 strike, out of the money, fair shake, decent premium for May. That's not too bad. I'd like to get a little bit more, but that's not too bad. But going that extra 45 days out, this probably did match my trading plan, as we mentioned, so that, for the first 20 days to April and the remaining 43 days there, we're getting at least that 2% return we wanted. So I'd say this is a possibility, even though it didn't show up in the rollout opportunities. Now, why is this showing a curved graph instead of a straight covered call? Well, this isn't actually simulating that you're buying to close this option. The custom spread tool is literally reading this, that you're long shares of stock, short an April call at 17, bought an April call 17 strike at 3.43 and sold a May 21. So it's looking at the profit and loss at April expiration. That's why I showed you that first step. So when I'm analyzing a position of rolling a call in a collar, rolling the put in a married put, or rolling the put in a collar, I take care of this action first. So I know my new effective cost per share on the stock would be 2013. So after everything's out, my new effective cost per share, 2013. Sell the May 21 call at our 75-cent premium. 78 cents, I guess. Yeah, there you go. And there's the 8.5% return if the stock is trading above 21. And as we saw, we probably only have a 30% probability at this point that the stock will be above 21 and will get assigned by May expiration. You can see that quickly. Just click the More Information button next to your call, delve into the option research page. Not 37.7, I was way off. So instead of 30% return, you've got a 37.7% probability. Pen would be above 21 at May expiration, and we'd get the 8.5%. But doing this manually, I would consider this a legitimate rollout opportunity. I think it didn't show up in the, in the rollout opportunities, maybe because the probability was too low, or maybe the volume and the open interest are too low as a reasonable trade to appear there in those rollout opportunities. So, long story short, Juan, that is how you can evaluate your positions and pick which strike price is the best one for you. Okay? Okay. That's a fantastic question that just came in. I'm sorry, I'm just going to look at I'm looking for something real quick here. I apologize. I thought it was here. It's not. Okay. So in this case, Paul asks a fantastic question. Now, it's not shown here, but Paul asks, how do you adjust your trading plan for different probabilities of being assigned and for different annualized returns? All right, let me take the first question first. First part first, Paul. How do you adjust your trading plan for the different probabilities? Well, is it better to say 41.3% at 7.4, which matches my trading plan, or 32.7 at 11.1? In this rough example, Paul, even though the 11.1 matches my trading plan for what I'd want to see, 1% return, over that 112-day period, 1% I was going to say per day, or 0.1% per day, I'm sorry, 0.1% per day. Unless I am extremely bullish on the stock, I don't think that 32% probability is a fair gauge. In this case, when I'm rolling up my covered call, Paul, it also depends on where I started. I'm not trying to cop out of an answer, saying that, oh, well, if you have a ratio of 41.3 to 7, that's much better than 32.7 to 11. You want the lower return to probability ratio. No, that's not what I'm saying. My trading plan, again, is, I have a 17 strike open right now at a stock I had a cost basis of 18 on. Where am I? I'm one strike slightly in the money. Okay? If that's my trading plan with the hope to getting assigned, as I mentioned, I'm probably not rolling this at all. I'm going to let it get assigned. Now, if I could roll up to the slightly in the money 20 or 19 strike and meet my trading plan for July or for May, I would probably do it. In other words, in this case, I'm probably trying to stick with a probability of 60% or higher. It would just be here, in fact, the July 19th, if that's my trading plan. Now, Paul, if I was looking at a standard collar, we're taking it in this count where I maybe bought pen at, or I had pen at a cost basis of 19. I had originally sold the 20 strike call and we're holding the 17 strike put, and now our stock is just above 20. Well, now I probably want to roll to the 21 strike or the 22. I may even roll the put up. We addressed that last week in the first question of our open forum presentation, managing the collars. But you're right. In this case, I'm probably not going too far to where the probability is below 40%. Personal preference for me on a collar. I want it still probably around a 45% probability. At the money, why? Because in my collar strategy, of course, I want to maximize what's known as the ATM bell curve. The at-the-money option will always have the highest time premium at any time. So even if I'm rolling to May in this situation, the 20 strike will have the highest time value. And that's what I'm fighting, right? I want time value decay in my favor. I want to avoid buying back if possible, and I want to sell into the best time premium. Well, in this case, yes, 20 has the highest time value, but it's already in the money. So I'm looking at the 21 because I probably don't want to be at the 22 strike or the 23 where the time value is so low on that ATM bell curve. I want to be in sort of this area when I'm selling, which would be the 20, 21, and 19. And we've already talked about if I started the collar slightly in the money and now it's moved up, sure, I might roll from the 19 to the 20. But if I started out of the money and now it's moved up, I'm probably going to roll from the 20 to the 21. I'm not saying just as easy as the next available strike, but I don't want to go to a probability in my trading plan below 35. If yours is different than that, that's fine. But you might not want to go to a probability below 20. The annualized question is not harder to answer. That's effectively what I did. I just did it without seeing the annualized percentage return. I said I was going to look for something, and I didn't. What's throwing me off here, Paul, is that for covered calls and for collars, I thought we did show the percent annualized return if assigned for a comparison in this case. But it's not here. I could have sworn it was. And you're right, because if I'm comparing 112 to 49 days, if there are 3 or 4 strikes at 49 days and 3 or 4 strikes at 112, I'd want to see the annualized return. But for me personally, I'm not looking at anything that has, in this strategy, anything that has a probability below 35%, really below 40%. I want to be at least here. And again, if the collar we're looking at, I'm probably just going 1 strike out of the money as well. So I'm going to look at that for you. There are calculators that we can use. Let's go back to our position. Oh, I'm sorry. Yeah, it's not. I have to be on the. Do I have to be on the option? No. Okay. Yeah. So from the custom spread tool, of course, I might be able to link to different calculator tools as well. I'm already on a calculator as well, but the calculator tool for covered calls will show you the annualized return. But yeah, that's something that should probably be there for showing different expirations, and I'll take a look at that for you on Monday. Get that taken care of. Fernando says he's got 2 questions. I'm going to take his second question, which is really a comment first. Fernando says the trading plan, I think, should take in consideration also the max risk per trade. Right. And I talked about that with the pen position. If I increase it in a covered call, we don't talk about the risk, which is why, we know the risk is to the downside. Even if we're using a stop order, if pen suddenly gap down 25%, well, that's just going to blow right through my 5% stop order. I'm going to get filled at the 25% loss price, not at my 5% stop. And that's why we use married puts and collars, of course, as you know, Fernando, and as you're trading. But I did mention that on the pen situation, that even though that rollout opportunity to the July 21 strike, even if it matched my trading plan and my time frame and my annualized return, as Paul just mentioned, I have to consider that I am increasing the cost basis significantly on this $20 stock, from my cost basis now of $16.70 up to $19.55. And if I'm concerned about a downturn, well, now I'd have to consider maybe I should convert this to a collar position out to July. But what's going to happen when I do that? I'm going to have to pay for the put. I'm going to lose that 7.4% potential return. Oh, sorry, wrong one. I'm going to lose that 7.4% potential return. It's going to drop down to maybe 5% based on the cost of that July put. Now I have to ask, does that 5% return match my trading plan for the 112 days out to July expiration? It probably won't. But you're right. That would be one of the ways, not the only way, but one of the best ways to control the risk here on this position, because I increased the cost basis so high. I might consider now with my 21 strike maybe buying a 19 strike put or a 17 strike put in that case, so that I'd curb the risk to hopefully only 4 to 5%, but I'd also lower this down to 4 or 5%. Now the potential max return may not be matching my trading plan, but I'd absolutely sleep better at night, because in that case we'd have the collar in place. Let's just take a look. What would it be again? So we saw our pen position. We know if we bought this back for about $3.43, our effective cost per share on pen would have gone up to $20.13. And we talked about selling the July 21 strike further out in time. And I say the 19, oh, that's no good. Yeah, I probably have to be as low as the 17 strike, and this is going to be too high of a risk for what I might look for in a collar, even 112 days out. Yeah, so I'm risking 12.5%. Instead of making 8.4, we're making 8.1. That's still reasonable, but I don't like that risk. Let's go up a strike to 18, excuse me. Standard collar going to the 18 strike, 3 points apart now. Better. But see, 6.9. Even this 112 days out, I probably don't want to have a risk higher than 5%. So you're seeing what I'm doing. I'm moving this up each time, which is costing more, giving me better protection, but lowering the return. This next one will probably take us down to 5.5% if you go to that 19 strike at $1. So we saw the 17, we saw the 18. Yeah, 5.3%, 4.8. Reasonable risk reward for a collar, but 5.3% might not match my trading plan for 112 days out in time. Okay. All right. So that's the comment there from Fernando about worry about the downside, which is important, convert it to a collar, but now you have to take into account, the trade-off, and is it worth it? Your other question, in a covered call, how and when do you decide to close the trade to limit the risk on a potential decline? Some of you have heard me say this, and it might bother some of you. Again, I'm not trying to avoid the question, and I'm not trying to be cliche, but if you're looking at a covered call position that you're currently in, and you're asking yourself, I think I should close this call, I think I should close this stock to avoid a decline, it's probably time to close the covered call. When that thought first creeps into your head, it's likely the time. Okay, that's not a fair assessment. Several things again. Let's go back to a structure. Let's say that I am in TREX. Okay, and let's say I bought it at 72. I'm sorry, not 72. Let's say I bought it at 67.50. And I'm holding a covered call position. I sold the April 70 call, slightly out of the money. Maybe I should use the 65 for this example. I'm going to use the 65 for this example. Okay. And with the stock at 67.50, I would have sold the 65 for probably about 210. Oh, wow. I meant 310. I said 210. Probably a little higher, but let's go 310. 1.2, nah. Okay, that's better. 2.5% return around the range I look for on my standard collar positions if I get assigned. It was a slightly in-the-money covered call, and now the stock's fallen. Okay, so first things I would have done in this position, Fernando, I entered a covered call and it's slightly in the money. Even if you did it at the money, even if you bought the stock at 67.50 and you sold the 67.5 call, why would you have opened this covered call? A, it had the return that you want. Okay, that's fine. The premium would have also had the downside protection you wanted. That's fine. You would have found the stock that you felt was neutral to bullish based on some fundamental or technical criteria. Whether you were looking for a stock that had a positive earnings per share growth, was a mid to large cap stock, maybe had a PE ratio, let's say, of less than 50, whatever your fundamentals are. Okay, less than 50, I'm sorry. 0 to 50 or PE ratio 0 to 50. You also would have maybe looked for some technicals on the position. Stock was above the SMA 20. Positive MACD, or maybe you use stochastics. Maybe you use Bollinger Bands. Maybe you use RSI, and you got into this position because the RSI had bounced off 30 or 40, was right at 50, and you thought it was going to go higher. Okay. So Fernando's question is, when do you consider to get out of the decline? Whatever technical or fundamental criteria you use to get into the position, that should be your signal to roll, adjust, or close the position if you see your preferred technicals reverse. If your stock now drops below the 20 or 50-day moving average, if the 20-day drops below the 50, if the MACD shows a negative crossover and goes below the signal line, if your RSI reaches 70 and you feel it's going to pull back off of that mark, or you see a combination of those three. Where else might I consider buying it if the decline is? Well, of course, if I reach 80%, as we already talked about, of what I expected to make on the covered call, I might close it, but that's probably already after the decline happened. So this is a good example, but the stock hasn't been at 67.50 recently. We're going to go ahead and take a look at the stock chart for TREX right now with those ideas in mind. These technicals and fundamentals I mentioned were the same technicals and fundamentals I'd probably use for a stock as far as MACD, RSI, maybe Bollinger Bands, other technical criteria. You can use stochastics and more. You see my chart is set up with the MACD and everything along those lines. Now, this is a tricky one because the last time the stock was in an uptrend to match those technicals when it was around 67.50 was here, back in the beginning of February. Also, we could argue that it was here in the beginning of January. Okay, look at where my trends were. MACD moving up, even here at February. Let's just take this one as the example. So that's a month and a half. Let's go to a 2-month chart. Let's clean this up a little bit. And yes, I know what this has done, so it's easy for me to say this. I'm not cherry picking per se. I don't want to, maybe I want to go 3 months. Do I want to go 3 months? No, this is good. I'm sorry, this is fine. Okay. So let's say my entry price was right about here. This is around my entry price at 67.50, whether I sold the 67.50 call, the 65, maybe even the 70. The stock did what I wanted. I'm above the SMA 20. That's the midline here in the Bollinger Bands. I've got a positive MACD sort of crossover here. My RSI is above 50. That's good. Okay, so now the stock starts to trend up. It's going exactly what I want, doing exactly what I want, doing exactly what I want. A little hesitation here. No, really here. And it might be too late. And you might think of it's too early. But right here, what do I have? The stock has dropped below, and this is a month later exactly. We got in maybe around February 3rd or 4th, right around March 5th. What happens? Stock has now dropped below the SMA 20. The MACD crossed over here early as a signal, but hey, it was still at 75. I'm still looking to get a sign. That's still okay. But right on March 5th, what do I have? I have a negative MACD performance. Stock just dropped below the SMA 20, and the RSI just started to go below 50 and enter into the negative. The 3 technical indicators I might use all clicked. That should have been my possible exit point on the position. But it's tricky, isn't it? Why? Because in this case, remember, I'm here. I sold the 67.5 strike. But this is a great warning for me, isn't it, Fernando? All 3 things have been triggered on that date. I'm below the SMA 20. I've got a negative MACD crossover that's been about 8 days old now and still declining. And the RSI just dropped below the midline, below 50, showing very negative strength. But I'm okay. And even here, I'm okay. Now here, I'm not. Why? It's sort of the 4th thing and 5th. Where do we have, well, excuse me, what do we have right here? I'm below the SMA 20. I'm negative MACD, but not only that, I've crossed below the divergence line on the MACD, and it's still declining. I've got an RSI that tried to recover, and it looks like it's trying to, but it's still not getting any higher. We had the discussion last week, if the RSI is around 30, that's a signal it's usually going to bounce back. Hey, this tried, but it absolutely didn't, did it? It kept going down. It's at 30 here, tried to move back. Hey, it's coming back up. No, it went back down again today. Not always a guarantee that's what's going to happen. So I'm here below the divergence line on the MACD, still negative, still below the RSI, just dropped below the lower Bollinger Band and below the SMA 20, and now I'm right at my call strike price. This would be the time. I could have done it here, right? What I saw all 3 signals check. But I was still, since I started the position in the money and had the great run up, I'm still okay. My short strike's at 67.5. Now it's gone below that. It's dropped below the lower Bollinger Band and is declining, and is declining, and is declining. Sam says, yeah, that's a sell signal. That's a sell signal across the board. Sam uses the 20-day EMA as a sell. I might use that too, but I use it as a confirmation with other technical indicators. Sam might use that also. But yeah, I'm seeing sell indicators across the board. So at this point now, I'm below my short call strike. I'm seeing negative performance. This would be my trigger now on this covered call, Fernando, where I'd look to close, roll, or convert. What do I mean by convert? Well, I may just leave the call open and buy twice as many puts if I think it's still going to decline. It's best in this case in a covered call just to get out of the stock. If I'm in a married put and I see this signal, I might buy an extra put to convert it to a synthetic straddle to profit both directions, still with only having a 7 or 8% risk in the worst possible scenario at the peak. It's more flexible than the covered call to manage the married put, in my opinion. It's funny today, the stocks, spiked up about that 6% yesterday at low volume, and today it comes down on high volume as well. But I picked this stock because I know it, and I know what it's done. Those would be my signals. Again, here was my entry at 67.50 on the stock. And whether I sold the 67.50 or the 65, the first warnings are right here, below the 20-day declining MACD and declining RSI. But I haven't gone below my two potential strikes yet, whether I sold the 67.5 or the 60.50. 67.5 or 65, excuse me. This one, though, all three. MACD below the divergence, still declining. Just broke below the lower Bollinger Band, and the RSI is still declining. All negative. Now, again, I might have gotten trapped here. Not really. I mean, if I had rolled this down to the 62.50, it got close to that, and then it popped back up, but it's holding right there. That could have been an adjustment. If I'm at a profit here, which I might have been, by the way, you know, at this point, the stock's trading at 65, but remember, we probably got 410 over here. We're getting closer to April expiration. Yeah, we would have sold a 3-month out covered call. That's what we're assuming, by the way, also with this trend, but it's just to illustrate the trend lines one could consider, one that I use, one that Ernie uses. This is what Ernie and I use. Sam uses the EMA 20. As I mentioned, I know other customers use stochastics. Whatever you use to get into a position, when that technical reverses, that's when it's time to look at it. If your covered call is based on using that you entered this in the money covered call that had a probability of, say, 70%, 65% that the stock would stay above that strike price, if the probability drops below 40% or 45%, you might consider rolling it. Of course, why did that happen? Well, because the stock fell and your call is now out of the money. It might be too late. That's why I use the price and the technical indicators. Remember, my technical indicators probably would have been triggered here, but I'm still in the money, a couple points in the money, almost 5 points in the money when that happened, right at 75, almost 10 points in the money if I took the 65. So I'm not at risk of it expiring worthless or even losing money on the trade yet. But when it gets below the strike and it's below the Bollinger Band and it's triggered my other signals, I'm looking to close, not looking to maybe adjust this covered call position at that point, but I might be looking to liquidate it to avoid further losses if it continues down. And hey, it could come back up. But I'm probably not losing that much at this point, am I? If this is an April call, that 67.5 April or 65 April right now probably might only be $1.10 to $2 to buy. Well, we put in the 67.5 right at about 410. And the current price for that, let me clear out those drawings there. And the current buyback price for that April, 70 to 95 cents. My cost basis was 63.40. The stock's at 61.52. So I'm taking a loss here. But remember, it was below 59 the other day. It had dropped down to 59 during the trading day. That's why, oh, I'm sorry. My apologies. I want to go to the 19th, don't I? I want to look at where that 67.5 strike call was around the 19th and 20th. I'm so sorry. Let's go back here. Let's go to option chain. And let's go to March 19th. Take a look at the historical chain. Okay, this was still 69.22, so let's go to the next day. It would have been the 20th when we saw that drop. That was a big drop. That's the big drop. The first one. The other one was the other day when it dropped below 59. 65.59, right near, if I was in the 67, it's now below it. The April 60, oh, there isn't even a 67.5, I'm sorry. There wasn't at that time. Make any sense? Oh no, we are using the 60. I'm so sorry, folks. We are using the 65. My apologies. So yeah, it would cost $260 to buy this back, and we could sell to close the stock at 65.59. So we're looking at a liquidation cost, 65.59, and we got to take away $2 from that. So we're only getting 62.80 back. And our cost basis was 63.40. We take a 60-cent loss, which is better than where we are today, 61.52, and it would cost us 70 cents to buy it back, so we're only getting 60.80 back. and a cost basis of 63.40, so we would be down to 60 instead of 60 cents if we followed the triggers. That's my response. And that's my answer, Fernando, to when I would look to roll or close a covered call trade if it starts to move against me, is when my trends, the reason why I entered the position, the reason why I chose this stock over the others that offered maybe a similar % return if assigned premium and downside protection, is because I thought it had better technical indicators for what I look for than the other positions at that time, moving above the SMA 20, a positive Bollinger Band crossover, increasing RSI, and other things would have matched that time. And I was right. And then I was wrong. But the triggers hit here, the warning hit here, and that might have actually been a trigger. If I had sold the out-of-the-money 70 strike, I might have liquidated at that time. But I was still looking good if I was at the 65 strike we analyzed. But once it dips down below, we've got 4 triggers here, below the SMA 20, dropped below the lower band, still declining in the MACDs below the divergence, still negative RSI. Yeah, you could say, oh, but it hit 30, so it's got to come back up. No, it doesn't. You know, it hit 30 here too, hit 40, and then it's starting to fall again. So that's where it is. But then the big one was, now it's at or below my strike price, where I want to say in the money. It's probably time to close this position because it looks like it's moving more bearish. We'll have to wait and see, because I was surprised, to tell you the truth. I thought this was going to continue down. Then boop, 6% up the other day. And then boop, 4.5% down today. So, yeah, that's the game we play, unfortunately, folks, which is why I'm glad I'm in this as a married put and not as a covered call or a bull put spread or a diagonal calendar spread, because it's been tending to bounce around. Might be fun as a weekly option trade if they offered weekly options, but as you can see here, they don't. You know, buying a straddle or strangle, but TREX doesn't offer the weekly series there. Okay, what was I going to look for? Oh, I'm sorry. I wanted to just look at something today here. I'm sorry. It was we saw that other 5% move, right, when we just saw it drop down to 65.59. We went back historically. That was just another time that it dropped. I want to go to the stock research tool. There it is. So yeah, it's up. Oh, it was down another 2. I'm sorry. This is what Sam had mentioned today. It had popped up 2.8%, almost 3.2%. I think it was up $2 today at the open, and then it gave back another $1.70. Let me go back previous day. That's what I was looking for. Yeah, so there's my 6% jump yesterday, up to 63.22. From 59.51, it was down 5%. So we went down 5% the other day on the 27th, then up 6%. Open today a little bit, down 3% up, and then end 3% down. So it was a 6% movement today, but you know, only dropped 2% from the open that we saw. The previous day was just down a little bit before the big drop. It was up a little bit. And then, of course, you know, we saw, there it is. There's another 5% move in the last 10 days. Things swinging all over the place here. Fun stock to follow, but man, it's hard for me to say, hey, I finally reached my conclusion on this one. It's going to do this trend next and this trend next, but it's going to bounce around 4 or 5% at least twice in the next 5-day period before I hit my 30-day mark where the trend I think is going to happen. Yeah, I have those faults the same as everyone else. I don't have anything over you as far as picking which direction is going to happen next with all the, lack of a better term, Looney Tunes that a particular stock is doing to you during a certain small time frame. But that's why I'm very glad this is a married put and not a covered call, not a diagonal spread, and not a straddle or strangle. Straddle strangle would be beautiful, but you'd have to catch it right because it's daily, as we just saw. 3 times in the past 5 days, it's moved up or down 5 or 6% in a one-day period. Yeah, Sam even mentioned he had a little bit of loss on this, but you know, who knows what could happen on Monday. We could go back up 4%. We could drop another 4%, or it could do nothing. I know that's vague, and I'm not trying to sound like a guru of stock picking. That's why I use options, is to pick the structure that works best long-term with the right types of stocks rather than trying to pick every stock right every time, because I haven't been able to master that. I don't know anyone out there who has. All right. Well, ladies and gentlemen, we are at 5:51 p.m. Eastern Time. I do not see any other questions that have come in. If you have a last-minute question, please feel free to send that to me. But I just want to remind everyone, of course, here, as it looks like we're about to wrap up, is that today's material are my thoughts on your questions designed for educational purposes on options investing to increase investing performance, ideas and concepts of how to limit risk and roll position, and options knowledge. Any stocks or options discussed today specifically shouldn't go out and necessarily open a covered call on Penn on Monday, for example, or on TREX, or open a straddle on TREX, for example, without your due diligence. Any stocks or options discussed today should not be taken as direct trading suggestions. They're just examples to illustrate the concepts that you asked about for managing risk, rolling positions, adjustments, triggers, how to maximize returns by the structure of the trade as well. Options do involve risk, as we all know. It may not be suitable for all investors. For those of you that like the tools we saw today, we played around with the search tool a little bit at the beginning. We illustrated the ideas of the default searches that Ernie and I have created in all those strategies. Those are essentially our starting points for what we would look for if we were opening a new position in that strategy today. We're not claiming them as recommendations or suggestions again, but it's a way to get started. But you can customize any of those searches and any of those strategies with stock and option criteria to match specifically what you want in a given strategy. It is an amazing time saver. You just click on the page, click on the search, you open your saved search for your criteria, you see the top 10 possible trades, top 15 possible trades that you would trade today. What's better than that? You know? The portfolio tools, very powerful, not only for being able to track your positions easily, compare liquidation and future expiration, but have all that hard work done for you for potentially evaluating a rollout opportunity or adjustment, and of course the other research tools we looked at. Great time saver, great tools to use. If you haven't done so yet, you can test them out for 14 days for free. Go to PowerOp.com, just put in your name and email address. You'll have full access to the site for 14 days, no credit card needed, no risk of being billed at the end of your 14-day trial. After that, our subscription levels start at about $40 per month for the end-of-day data. We do offer a delayed service. Data is delayed about 15 to 20 minutes, gives you access to most of the tools there, I should say, but all the tools for searching, analyzing, and tracking your positions. We do offer a back-testing suite of tools where our data goes back to April of 2006, and of course a real-time service and an all-inclusive service as well, the premium service. Interested in other education this weekend to pass the time? If you find yourself at a lull and want to get some education, check out the blog, blog.powerop.com. You can put in a search for anything, covered calls, credit spreads, and you'll see our different blog articles on trade entry, criteria suggestions, management, and more. Also, the webinars page, powerop.com/webinars.asp, is a public page. You don't need a trial or subscription or to be logged in to access it. On the webinars page, you'll see a variety of webinars, of course, in the Power Options tools, but more importantly, a full section on option strategies, how to be successful with credit spreads, managing naked puts, managing calendar spreads, calendar spread criteria, bullish or bearish spread criteria, how to be successful with long options, and more. Our thoughts on all those strategies available for you. And of course, all of our Friday discussions are archived under the Requested Topics tab on the webinars page. Of course, you can always follow us and check us out on YouTube, just under user Power Options. Oh. Well, ladies and gentlemen, no last-minute questions came in. I want to thank you for joining me today. I hope you all have a fantastic weekend. If you think of any questions over the weekend or next week, remember, send me an email at any time to support@powerop.com or support@radioactivetrading.com. And remember, you can also call us during market hours at 302-992-7971. And as I mentioned at the beginning, those of you who are currently trial members or subscribers, you can schedule a coaching session at any time for that free one-on-one session with myself or Ernie. Ladies and gentlemen, thank you again. Have a fantastic weekend. We'll see you soon. Good night.